I'm Ron DeLegge with ETF Guide. Great to see all of you. I hope your 2026 is going well so far. And I want to give you a quick update in this particular episode. We're going to take a look at some top performing ETFs, some areas with momentum, take a look at the industry sectors, and also some bigger picture macroeconomic big investment themes that are happening, not just this year, but are what I would consider multi-year themes that are a continuation of some of the things that began in previous years. Now, if we take a look at the poll, this was one of the questions I asked you, our audience at ETF Guide TV at the beginning of the year, or maybe it was at the very tail end of last year. I asked you which ETF categories do you think would be the strongest performers for 2026? And you overwhelmingly agreed, most of you, that it was going to be technology. Over 50% said that. And then behind it, cryptocurrencies, other, and then real estate. We're going to take a look to see how accurate you've been so far. I'm going to give you an update on that in terms of industry sectors and performance and see if technology has been the place to be. In terms of your feedback, we had some nice comments from Mike. He's enjoying our episodes and weekly shows as well as updates. And he said, I recently got some gold and silver to balance my crypto positions. It seems that when metals are up, crypto is down and vice versa. Well, I took a chart, and this is over the past 2 years, Mike, of cryptocurrency as measured by Bitcoin. Now, this is not a basket of cryptos. It would probably been more accurate if I'd have done a basket of cryptos versus a basket of precious metals, which is GLTR. GLTR is an ETF that tracks gold, silver, platinum, and palladium. It's a 4-in-1 ETF. And if you want like just exposure to precious metals in one ticker, GLTR is what that does. And as you can see here, related to Bitcoin via IBIT from iShares, they've both been in the same upward trend. Now, obviously, it's not going to be a one-to-one correlation, but you can see the trajectory in terms of upward performance over the past 2 years has been in the same direction, with the advantage in terms of performance to the upside in favor of precious metals, up 164% versus 120% for Bitcoin. Strong performance across the board for both. And if we just look at this particular 2-year period, they seem to be pretty correlated to me. In terms of other feedback, Jim correcting me, it was Rip Van Winkle who fell asleep for 20 years, not Rumpelstiltskin. And thank you for making that clarification and correction. You're exactly correct. I keep referring to Rumpelstiltskin when I should be referring to Rip Van Winkle. So thank you. I will not make this mistake again. If I do, Jim will be there to correct me. And we got Tony from New York, Nvidia. Yeah, Tony, Nvidia, with an emphasis on nah. I'm from Chicago. That's my accent coming out. So it is Nvidia. How you like that? At least I got the ticker symbol correct. The 3 cornerstones of an architecturally sound investment portfolio. What are they? Well, the DeLegge framework for building a architecturally sound, robust investment portfolio is 3 containers: your core, your non-core, and your safety bucket, previously referred to as your margin of safety. Each of these buckets operates differently, and the types of investments you own in each of these buckets is different from the other. So, for example, investments that you own in your core portfolio or core container would not be the same as the non-core or the safety. And again, this applies to across the board. You don't want to have any overlap of the types of assets because you want each of these ETF containers or portfolio containers to do something different than the other. And so this is the framework that I encourage all of our viewers to adopt in their own portfolios. I think that it's robust, it's smart, it also protects you and allows you to make money in any kind of climate. I'm going to ask our viewers a question about these containers. I'm going to test the intellect of our audience to see how well you know which investments are fitting or suitable for these containers. We're going to just focus on one container, so stay tuned for that. Now, in terms of a broader big picture performance for 2026, we could see here that the runaway winner thus far has been Bitcoin. IBIT, which is up over 9% and having a great run. I remind you that last year Bitcoin was an underperformer. We're seeing a little bit of a reversion now. We're seeing outperformance to the upside for Bitcoin relative to U.S. stocks, which S&P 500 has gained about 1.5%. Bonds, U.S. bonds, narrowly up. You've got global real estate ahead by almost 4%. And then commodities have been strong performers, up almost 4%. So that's your big picture view. And again, I think this goes back to when you look at the performance, the outperformers, it's really the debasement trade, real assets, assets not denominated in U.S. dollars. We're going to talk about that in a second. Hold your horses. In terms of S&P 500 industry sector performance, we got 11 industry groups, all 9 out of 11 are up, and we got 2 down. And you'll notice that the laggard XLC, that's been a hot performer over the past several years. That's been like one of the best performing industry groups. This year, not so much. You take a look at the changing dynamics of the sector performance and the rotation to energy, materials, industrials. These are the areas thus far in 2026 that are outperforming. We're going to share with you a couple of other ETF ideas and strategies for those in a second. In terms of January, this is sort of a historical reference point. If January is good, then you can see from this chart, as far as historically speaking, the final 11 months of the year tend to be up 87% of the time. That's if we have a positive January. So this is called the January barometer. And I would not say this is, something I would necessarily trade off, but it's a good historical reference point. And certainly if prices confirm the historical reference point, I think that makes a strong argument for maintaining equities. Now, in terms of another indicator, this is the presidential cycle indicator. Currently, we're in the second year of the U.S. presidential cycle, mid-year term. And you'll notice historically, it's been pretty much a flat year relative to the other years within the cycle. Again, I would put more emphasis on prices versus seasonal patterns, presidential cycle patterns, and all these other patterns, which to me are just noise. They're interesting references as far as history, but we know that prices ultimately determine the winners and the losers, and so that's why we place a higher emphasis, at least I do, on immediate price performance and price trends and action. Right? That's what we should be paying attention to, and that's one of the reasons we also do this weekly update. Now, in terms of year-to-date performance, this is since the beginning of the year through the market close of January 16th. The chart's cut off a little bit there, but this shows you the upward trajectory, getting back to the debasement trade of silver miners, gold, and gold miners. You've also got copper. The performance trend, the bullish trend, is up. All of these ETFs are performing strongly. Put them on your radar. And certainly if you're looking for bullish upward performance, you're getting in here from SLVR, Goldbug, GBug, and then, of course, COP. We've got other ETFs in the leveraged area, 2X, 3X. We got Nugget, JNUG, both great performers, delivered huge numbers last year, and they continue to add on to that. Both of these areas focus on gold miners. JNUG, of course, focus on the smaller, or what they call junior gold miners, smaller caps. ERX Energy, nail home builders. There's been a lot of stuff happening in that sector. Talk about people being able to take money out of their 401k retirement plans to make a first-time home purchase. So that's been helping to lift that area. And then DUSL is focused on industrials, and all of these ETFs performing strongly and delivering some pretty impressive results thus far. Now, why is the debasement trade, real assets, non-US dollar denominated trades, why are they doing so well? And I think this is something that has been started in previous years, and it continues, though, and it's going to get stronger. And I think it's going to become a more important theme as runaway national debt here in the U.S. continues to increase and become a real problem. And there's been a lot of folks talking about this, and it's a slow-moving train wreck, but it is a train wreck. And eventually that train is going to land in a place we don't really want to know. We're right now at about $38.5 trillion. We'll be over $40 trillion this year. We're going to eventually be $50 trillion. It's a problem. It's a problem, especially when interest rates, the cost just of servicing the debt, we're not going to have enough money to even cover that. We're running deficits on that. But there's also been a lot of talk about tariff revenue. Of course, tariffs back in the news again. Supreme Court still not making a decision on whether it'll allow the president to continue with tariffs or not. And this time, tariffs being used to finagle Greenland away from Denmark. It was originally used, tariffs, as a way to increase revenue for the U.S. government. Now it's being used as a strategy to add more territories. But the question is, from a mathematical perspective, is there enough tariff revenue coming in to pay for the $1.9 trillion in annual budget deficits? And this is the hard math, folks. Don't listen to any politicians that tell you that tariff revenue is enough to cover the massive hole of $1.9 trillion budget deficits, because not even close. Not even a Hail Mary, not even in the same zip code. About $180 billion January through September of 2025 in tariff revenue. Not even close. It's not even six. You need 6 times more tariff revenue to even match what they're running in terms of budget deficits. Well, where's all that money going? Here's the answer. Social Security, Medicare, and Medicaid account for nearly 75% of mandatory spending. We've all heard it for a long time. Baby boomers, aging population, more people taken out of the system than putting in. This is the hard math. And, the question then becomes, if so much money is being extracted and demanded from the government, well, how are they going to pay for all this? They've got U.S. national debt, plus on top of the U.S. national debt. Remember, that does not include all these unfunded liabilities, which are much larger in scope and scale relative to national debt. We've got Medicare, Medicaid, Social Security. You add that on top of national debt, we're looking at over $100 trillion of liability. So how's the government going to pay for all this? Well, you could borrow more money. Oh, you can't do that. You could print more money. Oh, you can't do that. Well, that leaves you with 2 unfriendly options. You cut spending or increase revenue via tax hikes, or some combination of each. And so what this means is, again, that thematic trade of the hard assets, real assets, finite assets that can't be manipulated like fiat currencies, things like gold, silver, important commodities like lithium and copper and uranium. And then, of course, you got digital assets of finite value like Bitcoin. So this is why these types of assets are becoming attractive to many investors. In terms of how you should be positioning your money, it's not just a thematic trade. It's also correctly positioning your money from a tax perspective. Because if tax rates are going to be higher in the future during retirement, which I believe they will be, and they're not just going to be higher by a little, they're going to be higher by a lot. That means people my age, younger, and people that are already nearing retirement or entering retirement are going to be in a higher tax bracket in retirement. Well, that means that all that the stuff that you were taught that, you'll be in a lower tax bracket when you retire, not going to be true, which means that all those required minimum distributions, also known as RMDs, are going to come back at you with higher tax bill. And so how do you position your money correctly? Well, that's what our Retire Securely course offers. Hit the description section below. It discusses that. We also have 2 other courses, Habits of the Investing Greats, and then Safety, which is a guide for investors. I got some questions for you on safety. The question is, right now I'm posing it to you. We know that safety is one of the 3 buckets, the 3 cornerstones of a architecturally sound investment portfolio. So what types of assets qualify? What types of investments qualify as safe investments? Hit me up with your answer in the comment section below. I want to hear from you. I want to see what you say. And those of you wondering, well, Ron, what's the answer? Well, I'm not going to tell you. That's right in our safety course, which is free. completely free. But I tell you right there in that course, the types of assets that are specifically and explicitly to be used in your safety container. And it's very much important to understand that it's all about making sure you're wearing the right clothes to the right event. For example, you would never wear snow boots to the beach. Doesn't make sense. In the same vein, you would not own certain types of ETFs or stocks or other assets in a safety container because they're not the right clothes. In terms of our billionaires index, this is the top 10, the big money. So how did they get so rich? How did they make their fortunes? Well, look at the industry sector that they made their money in. Technology. 8 out of 10 made their fortune in technology. So even though technology has been a lagging industry sector and area thus far in 2026, and that may persist. We may even see technology dip. The big money is staying put, and they're not changing their. And really, when you think about all the stuff happening in technology with the build out of AI, data infrastructure, all of that stuff, robotics, I mean, it's massive. And the digitalization of society is not going to stop anytime soon. It may pause, it may slow a little bit, but it's still heading in the same direction. And there's a lot of fortunes yet to be made. And so that's a good lesson for all of us, especially from an investment perspective. ETF Guide had a rebrand. We updated our logo. We also have a new website, which just got redesigned. And I encourage all of you to check it out. Give me your feedback. It's at etfguide.com. And really, I wanted to, when I was talking to my graphics team, I wanted to have a design that really conveyed that I'm going to be here and we're going to be here for you in all market climates. Not just up markets when there's a lot of chirping and chatter, right? But then all the schoolboys and schoolgirls and all the baby influencers, once markets start to sink or go down or get more volatile, they all disappear, right? They all vanish because they got no answers. Well, we got the answers, and we're going to help you make money in all types of climates, up markets, down markets, volatile markets, flat markets. And again, this is all about educating you. Our online courses are free, and they're available to all of you. So take advantage of that. Hit the description section below. I hope you enjoyed today's episode, and certainly that you're positioning, and this episode helped you to position your money for the path ahead and what's coming. Really, it's all about anticipation and being ready for the next big move. I'm Ron DeLegge with ETF Guide. We'll see you on the next episode. And again, thanks for watching.